Well, good morning, everyone. On behalf of Sikich, I'd like to welcome you to our webinar today. My name is Anthony Cervini. I'm partner in charge of government services here at Sikich. Our topic for today's webinar is getting technical with GASB Statement 87 on leases. What we'll do is we'll go through and provide a overview, kind of a refresher on some of the components of GASB Statement 87. And then the second half of the presentation will be a demonstration of Sikich's proprietary tool to assist you with your implementation of Statement 87, our lessee ledger, and go through an example, several examples using the tool on that. So again, thank you for taking some time out of your day to join us. I'm going to go ahead and turn off my webcam and let you focus on the slides here and make sure we got enough bandwidth to go through on everything from our presentation today. Few housekeeping items before we get started this morning. We do have a CPE available for today's session. We will be tracking CPE and attendance with a tool called conferences.io. This will provide tracking for you there. So to receive CPE credit, please do check in or check out with your company email for those of any internal attendees that we have today. This will communicate directly to our system there. For external attendees, please make sure you register and check into the system using the same email that you registered with for today's session. You'll input all of the code words or code numbers through the conferences.io screen. We'll also be posting those codes to the chat box as well, so you'll be able to have those in multiple places. If you do run into any issues with getting into conferences.io or anything for that, certainly feel free to reach out to the Sikich events in the chat box as well, and we'll be happy to navigate those with you, make sure that we track everyone who is here, make sure anybody that is looking for that CPE credit does have what they need to get that. Logging in using the conferences.io tool, you can either go to the website listed there or scan the QR code and log into the session titled Getting Technical with Statement 87, again featuring a live demo of the lease standards tool, so you can see what the app looks like from a smartphone there. Similar setup, similar look on the screen as well. We'll go ahead and get us our first number here for the day. Our first code for the day is 456. Again, 456 is the code there. There's some instructions on the chat as well. Moving right along here. Again, we'll start off with the technical overview of the standard, revisit some of the key components of the standard for you, and then go through a demo of the lessee ledger tool. Again, I'm Anthony Cervini, partner in charge of government services at Sikich. Head up our state and local government practice here at the firm, have worked closely with our team in reviewing and testing the GASB-87 lessee ledger tool here. Also presenting and we're going through the demo of the tool later this morning is Greg Fidler. Greg, if you want to just take a moment and introduce yourself.
Sure, thank you, Anthony. My name is Greg Fidler. I have been with Sikich for over 16 years now, focused initially on client-facing audit and assurance work, and more recently on our assurance innovation. So I'm happy to be here and be able to present the tool that we've created and walk through a few real-life lease documents or lease scenarios to illustrate the concepts and how a tool is helpful. So thank you.
Thanks, Greg. As we go through the presentation today, please feel free to submit questions as we go through and go through the session today on that. If you do have any questions, we'll do our best to answer those. As we'll go through some of the examples and some of the details here, you'll find that Statement 87 there's a lot of nuances to it, and there's a lot of specifics that are going to be impacted by how your particular lease document may be set up on that. So what we probably won't be able to do is get into specific questions. You know, I have lease A, how do we treat for this? We're happy to kind of work through those with you, after the fact on that. So feel free to submit those questions. Any questions that we can answer that are going to benefit the entire group, we'll certainly do our best to send out an additional communication afterwards if need be as well. So with that, let's go ahead and get into the material and reviewing the material for you today. So at this point, we talked about this, and many of you have participated in previous sessions that we've done here. But again, the why and some of the key components as to what we have GASB-87 for, and why GASB has kind of continued down this path with Statement 96 on Sabitas on that. So we'll continue to talk through these things, more to come in terms of those as well. But ultimately, we have GASB Statement 87 because as GASB looked at the existing lease guidance that was there really ended up being a number of accounting and financial reporting issues that had developed. Now, this went back as far as NCGA Statement number 5 back in 1983, GASB 13 in 1991, and the evolution of the standards, especially as it related to the definition of an asset and the definition of a liability. Those came to us initially in GASB's Concept Statement 4 and Concept Statement number 6. So again, dated guidance on that, older guidance out there. Additionally, while GASB was starting to consider these things, both the Financial Accounting Standards Board and the International Accounting Standards Board had gone through and done a large-scale joint research project on the lease standards, developing revised guidance on the for-profit and FASB, ISB side of the house on that, with the intent of kind of looking at their overall lease reporting on that. Certainly, they've made some significant changes in that realm and their world as well. GASB followed closely what those two standard setting bodies were doing as part of that, and this kind of to a certain degree drove GASB's agenda to look into these as well. GASB went through a 4-year research period on this, did determine ultimately that new guidance was needed, culminated with the issuance of Statement 87. Kind of crazy to think about this, but Statement 87 was actually issued back in June of 2017, and then with Statement 95, due to the pandemic, had several, implementation guidance or implementation was delayed for this standard as well for this. So again, gave us some opportunity to really, hopefully spend some time kind of gathering these documents and going through the process to get what was needed there. So GASB does also have an implementation guide. Implementation guide 2019-3 was issued back in August of 2019. Effective for periods beginning June 15th of 2021, so June 30th, 2022, and thereafter coinciding with the implementation of Statement 87. So any June 30th, 2022 year ends, you've either already gone through and done your implementation or are finishing that up. December 31st, November 30th, any others that have not yet. This is what's coming for you. Again, trying to somewhat demystify some of these pieces and kind of go through for you in a way that will be helpful and give you the chance to better understand what we're looking at with the standard and how to effectively implement the standard at your organization. So with 87, what we have to look at is the definition of a lease. So if we've gone through and previously we looked at leases as operating or capital leases, Statement 87 removes that previous criteria, focuses on whether we have a non-cancelable contract that results in an asset to the lessor or a liability to a lessee. So the definition specifically here, 87 is applied to any contract that meets the definition of a lease, defined as a contract that conveys control of the right to use another entity's non-financial asset for a period of time in an exchange or exchange-like transaction. The asset, the underlying asset, the right to use asset is what's specified in the contract there. And then GASB further gave us a definition for control of that asset and told us that control is manifested by the right to obtain the present service capacity from the use of that underlying asset, and the right to determine the nature and manner and use of that underlying asset. At the end of the day, simply put, leases are financings of the right to use an underlying asset, and then GASB provided then a single, uniform approach applied to accounting for leases. Of course, with some exceptions here, short-term leases, we'll go through a few of those things as well, and some of the examples that we go through as well. Any contract that meets this definition should be accounted for under the guidance in Statement 87, unless it is specifically excluded as part of that. A few other things to note, and we'll see this as part of what we go through in a little bit here. Statement 87 does not include non-exchange transactions. So it's an important differentiation as you look at the standard non-exchange transaction, $1 per year lease, because you have to have a consideration associated with a particular contract there, does not meet the criteria and does not, as a non-exchange transaction, will not be reported under this guidance because it's at the end of the day, you're not going to report a $1 lease liability and lease asset or even a present value of that amount there. So that being said, that's our definition. A few caveats here, a few things to look at here. No classification into the operating or capital lease categories anymore. So again, if you've looking at a lease, determining which bucket it should fall in there, how you're going to report that, how you're going to present it in the financial statements, you no longer have to do that. Again, that underlying assumption that we are navigating with is that leases are financings. As noted, there are exceptions, both on the lessor and lessee standpoint. There is an exception for short-term leases. We'll talk more about that. What GASB does not want you to do is default to everything being a short-term lease. So there's a lot of caveats there. That kind of goes into the question aspect for things to be able to say, okay, well, is this actually a short-term lease, and being able to make that determination and have that understanding in place as part of that. If you have a lease that transfers ownership and does not contain termination options there, this is really an installment contract or a finance purchase agreement as placed. It's really not any different than issuing a note payable to acquire an asset. Certain exceptions for lessors, specifically leases of assets that are investments, or if you have certain regulated leases, so airport airline agreements, for example, those are regulated outside the confines of Statement 87 there. So again, some nuances that maybe may impact your organization depending on the type of lease activity or lease type activity that you have. So as we've gone through the first wave of implementations on Statement 87, there's various things that have come up. We'll go through here in a little while some of the questions that GASB has gone through with their implementation guidance on this, and then the Q&A that's been put out as it relates to Statement 87 on there that will address some of these things. But I think one of the most important pieces and where we have potentially some of the biggest exposure and risk when it comes to properly stating a lease is looking at the lease term. So the question becomes, when does the lease start? When does the lease end? So what we start with is the non-cancelable period of that lease. Looking at our examples here, plus any periods covered by options to extend the lease, if those extension options are reasonably certain of being exercised, or terminate the lease if those are reasonably certain of not being exercised. The lease term should exclude any cancelable periods. These are periods for which the lessee and lessor both have an option to extend or terminate. So a rolling month-to-month lease, for example, would be excluded from that lease term. And GASB, again, wanting to make sure, and with the intent, if you look at the basis for conclusions on the statement, being able to make that determination and say, okay, well, if it's in substance is a lease, it should be reported as such. So GASB told us that any fiscal funding or cancellation clauses are going to be ignored. unless they are reasonably certain of being exercised. So some of those outs that are put into these lease agreements or contracts there, generally GASB says unless you've got a reasonable certainty that you're going to exercise those are not factored into the into the calculation of the lease term. Short-term leases, GASB was very specific, as I mentioned, wanting to make sure that they capture the full scope of what this standard is intending and trying to do as part of that. So the definition for a short-term lease is that it has a maximum possible term under the contracts that is 12 months or less. GASB chose that maximum possible term rather than lease term because they didn't want misapplication of the standard or the lease term guidance to manufacture short-term liabilities and essentially avoid the reporting that the standard is trying to accomplish as part of this. So again, maximum possible term under the contract, 12 months or less. Under short-term leases, then, the lessee accounting will recognize the expenses or expenditures based on the terms of that contract. No recognition of assets or liabilities associated with the right to use the underlying asset. On the lessor side of the equation, recognizing lease payments as revenue based on the payment provisions of the contract, no recognition of any sort of lease receivable or related deferred inflow. Revisiting the reporting here, again, this is a significant change in terms of what the previous guidance was on this, but GASB, as we've seen with some of the components of statements issued after 87, statement 94 on public-private and public-public partnerships, as well as statement 96 on subitas for that they like what they've done on this guidance here and really have leaned into this with those particular standards as well. So conceptually, this will apply to not only 87, but those other standards as well. So once we've made the determination that we have a non-cancelable contract that meets the definition of a lease, we're going to look at what the reporting is for the transaction at the inception of the lease. In the year of implementation, you're going to record this at the beginning of the year for the remainder of the agreement. So on the lessee side, you're going to report an intangible lease asset or the right to use that underlying asset. This will be measured at the value of the lease liability plus any prepayments and initial direct costs that are ancillary to place that asset in use. That asset will be offset by a liability. Liability reported as the present value of those future lease payments. That would include any fixed payments, any variable payments based on an index or rate, as well as any reasonably certain residual guarantees that are part of that contract. On the lessor standpoint, you're going to report a lease receivable. This is generally going to mirror what's reported as that lessee liability. One of the key differences that GASB had from the FASB and International Accounting Standard Board and the IASB side of standard that was issued there is that GASB did not require a derecognition of that leased asset for a lessor. So you're going to continue to report that leased asset. The guidance under ASC 842 did require, in most cases, a derecognition of that leased asset for the lessor. GASB did not incorporate that into their guidance here. The offset to the asset on the lessor standpoint then is a deferred inflow. That deferred inflow being equal to the lease receivable, along with any cash received upfront that is related to a future period there. So from a reporting standpoint, then how do we report these? Where to record these? All accrual-based economic resources, measurement-focused financial statements here. If you have governmental funds or sub-funds using the current financial resources measurement focus, long-term liability and the intangible asset is reported as part of your conversion entries, not in your governmental funds. At the inception of those leases in a governmental fund, offsetting expenditure and other financing source recognized in the period the lease is initially entered into. That will be at that net present value amount of the lease. Again, any subsequent payments are going to be recognized in accordance with GAAP principles there. for debt service payments on long-term debt, principal and interest expenditure separately. Subsequent years then, what do we report in kind of going forward standpoint here? For the lessee, we're going to amortize the intangible lease asset over the shorter of the useful life or the lease term. Unless you have a situation where the useful life is shorter, which may lead you to another question as to why that lease was entered into. You're going to reduce the liability by lease payments, less any amounts for interest expense as part of that. No amortization expense reported in the governmental fund level. Obviously, that is at the your full accrual economic resources level from a presentation standpoint there. On the lessor standpoint, you'll continue to depreciate that leased asset unless it has an indefinite life or it's required to be returned in an original or enhanced condition. Your receivable will be reduced, by your lease payments, less any amounts needed to cover that accrued interest. And then your deferred inflow on the lessor standpoint, recognizing revenue over the lease term in a systematic and rational manner. So again, a significant change in terms of the existing guidance here, but this is what the standard has outlined here. In terms of our note disclosures then, for the lessee, note disclosures here, a general description of your leasing arrangements. This would include the basis, terms, and conditions on which any variable payments not included of the lease liability are determined. Also need to disclose the existence, terms, and conditions of any residual value guarantees provided by the lessee that were not included there. In addition to that, total amount of lease assets by major class and the related accumulated amortization. This should be separated out from your existing capital assets. You can have it all part of one note, but these assets should be presented separately within that guidance. Any outflows of resources recognized for the period for variable payments or other payments, residual value guarantees, etc., penalties that were not previously included. Principal and interest disclosures to maturity for each of the next 5 fiscal years and in 5-year increments thereafter. Any commitments under leases that have not yet begun other than short-term leases, and then if there's any net impairment loss recognized on the lease asset during the period. On the lessor standpoint, again, a general description of those leasing arrangements, looking at those variable payments, for example, there. Any total amounts of inflows of resources, lease revenue, interest revenue, if not otherwise displayed on the face of the financial statements. Inflows related to those variable payments, residual value guarantees, penalties, etc., that were not part of that initial calculation of the lease receivable. And the existence, terms, and conditions of any options by the lessee to terminate the lease or abate any of those payments. If there's a situation where the lessor government has issued debt for which the principal and interest payments are secured by those lease payments there. Again, if you do have a situation where you have specific disclosures that are required, for leases of assets that are investments, regulated leases, if you're in the sublease or sale leaseback, leasebacks, all additional disclosures that are required as part of that. So, and then finally, if you are in the business of leasing assets to other entities, you should disclose, and your principal ongoing operations consist of that, disclosing a schedule of future payments that are included in the measurement of the lease receivable, showing any principal and interest for each of the 5 subsequent years and then 5-year increments thereafter. So the second part of what I'm going to cover in my comments here is going through for you some of the key questions and some of the implementation guide questions that have come out on Statement 87, some of the guidance that GASB has provided for us on Statement 87 and some of the clarifications that are made. Just recently, GASB issued 2022, 2023 guidance on this that is coming out. We'll finish up before going into the demo, looking at some of that information for you as well to be able to look at some of the most recent guidance that is currently under consideration and will potentially go into effect in calendar year 2023 for that. So we'll go through that, highlight for you where to find that information as well from a reference standpoint, just to provide you some additional guidance and resources that you can go to as you assess your leases, assess your lease portfolio, and go through this process. So the first question we're going to go through here is 12.2.1. Question asked here, the government obtains the right to use land which has a market rent of $100,000 per year for $1 per year. Question asked then, should the government apply the requirements in Statement 87 to that transaction? Our answer here, as we talked about, again, GASB-87 is specific to exchange or exchange-like transactions as part of this. So the answer here is no. Again, the definition of a lease looks at those exchange or exchange-like transactions. Paragraph 1, Statement 33, classifies transactions into essentially those two categories that you see, exchange or exchange-like or non-exchange. The right to use that land for $1 does not meet the description of an exchange or exchange-like transaction. That's because the two parties in play here are not receiving or giving up equal value or not quite equal value, not even close to equal value in this particular example here. So again, looking at the substance of that transaction is a key requirement as we go through and assess whether or not a particular agreement or contract is subject to the lease guidance. Right. Our next key code that we have here is 375. 375 is our next key code here. So enter
Anthony,
that.
We're taking a break for the key code. There was a sort of a general scoping question related to, so for property leases that are leased to own, I assume those are not considered included in these types of leases. Is that correct? So I think the question there is related to arrangements where maybe there's a transfer of title or a purchase option for a nominal amount. Do you want to address that?
Yeah, I'd say generally, without getting into, seeing the specific agreement there, Greg, it's really dependent on how the contract is structured and what that, if the purchase, what the purchase option looks like on that there. I would say it can be kind of, gray on some of those things, but I would say as we kind of go through some of the questions here, that may be clarified. If not, I'll circle back on that one as well. But that's a very good question. So moving on to our next question here. So 12.2.2, a government enters into a multi-year agreement for the right to use a facility. The government has exclusive use of the facility 3 days a week. Other parties are able to utilize the facility on the other days. To meet the definition of a lease, is the government required to have uninterrupted control of the right to use the facility? In our example here, the answer again is no. In this case, the question that we have here, we look at this and look at the GASB's response in determining whether a contract conveys control of the right to use that underlying asset. The government has to assess, can it control? Does it have the right to obtain the present service capacity and the right to determine the nature and manner of use of that underlying asset as specified in the contract? So if your contract in this case says that you have those particular rights during 3 days of each week, you do have that control criterion that's met as part of this. The provision that the contract be for a period of time does not specify or require uninterrupted control or right to use of that facility. So it does meet the criteria for a lease here, and it would be, part of, would be captured under the lease guidance under Statement 87. Question that's come up quite a bit, do easements meet the definition of a lease? GASB in 12.2.5 provided the answer that an easement provides the right for use of a tangible asset, for example, land. And then our favorite answer that we get from time to time on standards here is sometimes it meets the definition, other times it's not. Again, looking at that, it all goes back and it all reverts back to the definition of a lease here. So Paragraph 4, a lease is for a period of time in an exchange or exchange-like transaction. Permanent easements, those are indefinite, last indefinitely without any cancellation options, aren't going to meet the period of time criterion. Additionally, if there's easements that are obtained for an amount that does not meet the description of an exchange or exchange-like transaction in statement 33, then those are not going to meet the exchange or exchange-like criterion there. So again, a couple exceptions that you can look to determining on the nature of the easement there. But again, you have to look at the substance of that specific individual transaction to make the determination as to whether or not the lease guidance is going to be effective for that particular agreement or contract. 12.2.8, another common one that we see are cell phone tower or antenna placement agreements leases. Again, here, GASB gives us the answer is that it depends. If it meets the definition of a lease, then including the control criterion, then yes, those agreements are going to be leases there. That control criterion is generally going to be met if this agreement conveys control or the right to use the land on which the tower is placed or the connection point to which the antenna is affixed. So in most cases, that control criterion is going to be met kind of based on that guidance that GASB has provided there. 12.5.1, entering into a lease agreement that conveys control of the right to use a parcel of land to a company that engages in oil and gas exploration and production. Is this lease excluded? Response from GASB, no. In this example, the company has the control of the right to use the land itself. Now, if the government had a different setup or a different contract in place here, where only the company was being only provided with the right to explore, but didn't have control of the land, then you would have it excluded from 87. So paragraph 8A of statement 87 does exclude the rights to explore for or to exploit natural resources, but that applies only when the underlying asset is the right to explore or the right to exploit those resources here. Now, don't anticipate this impacting a ton of our attendees and the clients at Sikich that we work with as part of this, but conceptually here, going back to this idea here, things that are potentially covered here. And we ran into a situation with several of our clients for June 30th, 2022, where they were the lessor or a lessor type position, I should say, with an asset that they controlled, but the asset was intangible in nature. Now, this intangible asset in nature, we actually ended up going to GASB directly to ask the question as to whether or not this was something that was going to fall under the statement 87 guidance. And GASB's response was no, because the intangible asset nature as the lessor standpoint was not something that was considered as part of that. So again, taking a look at what the underlying asset is and making that determination is a key component and a key, again, I can't stress enough the importance of looking at these specific agreements that you have and determining whether or not it is specific on that, having those discussions as early as you can on that process to determine that you do have a complete scope of and a complete accounting of all of your leases for that to encompass here, making sure that things that actually should be captured as leases, both on the lessor or lessee standpoint, are being tracked as such. We'll get into some questions now on the lease term. Again, this is one of the areas that I think is ripe for misstatements and errors in the calculations on this. So question 12.11.2, we ask, and we see the question, we have a lease contract that has a non-cancelable period of 5 years and specifies that at the end of the 5 years, both the lessor and the lessee have the right to cancel the lease or may continue the lease using the same terms on a month-to-month basis. The question here then is the month-to-month holdover period included in the initial assessment of the lease term. As we saw in the opening slides here looking at short-term leases, the answer here is no. During the holdover period, the lessee has not contracted for a non-cancelable right to use the underlying asset. and nor is the lessor required to continue providing that asset. So in this case, that holdover period is cancelable by either party and is excluded from the lease term. Question 12.13.1 asks, how does a bargain renewal option, such as a 20-year lease at a market rate with a lessee option to renew the lease for an additional 5 years at a 30% discount, affect the lessee's initial assessment of the lease term? Paragraph 14 gives us the guidance here. Again, at the commencement of the lease term, assessing all factors that are relevant to the likelihood that the lessor or lessee is going to exercise that lease extension or any termination options. Relevant factors include significant economic incentives or disincentives, cost of exercising the option, condition, maintenance requirements related to the asset itself there. So our takeaway from this one, in this case, if the governmental lessee determined that it's reasonably certain that the option will be exercised, then the lease term would be 25 years. So it would be factored into the lease term, again, going back to that expectation, that reasonable certainty of an option being exercised or not being exercised when it comes to a termination option there. One of the key things that I would recommend that you do as you go through and you make some of these assessments here is document your decisions that were made as part of this, document who made the decision there. If circumstances change, we're looking at 20, 25-year agreements longer in certain circumstances as part of these contracts and part of these documents that are part of these processes that you're going to go through and make the assessments on and interpretations on for that. Document who made the decision there. So if you do have a change in the circumstances related to that and a remeasurement is necessary for that, then you've got to document who made the initial decision. If that does change, again, documenting who approved that change there. Those are all things that you're going to want to have as part of your audit trail and have that documentation in place from a record keeping standpoint. Again, when you get into leases that are spanning decades in certain circumstances on this, that institutional knowledge is easily something that could get lost in the shuffle on this. Our next key code here is 342. 342 is the next key code for you to enter here. 342. 12.13.2, lease contract allows either party to unilaterally terminate the lease at any time, but does provide for cancellation penalties. Those cancellation penalties in this example are so great that it is reasonably certain that neither party will terminate the lease should those cancelable periods be excluded from the lease term. In this case, the answer yes. Paragraph 12 tells us that periods for which both the lessee and the lessor have an option to terminate the lease without permission from other party be excluded from the lease term as cancelable periods. Presentation of the presence of those cancellation penalties in this case does not affect that conclusion, even if those, even if it's likely that that contract is not going to be terminated. Those cancelable periods should be excluded from the lease term. So again, that cancelable nature of those periods is what drives the answer in this case. 12.13.3, taking that a little bit differently, a little bit of a different question here. Only the lessee can unilaterally terminate the lease at any time. Still has those cancellation penalties that are so great that it is reasonably certain that the lessee is not going to terminate. Should those cancelable periods be excluded from the lease term here? In this case, the answer is no. In this reason being is determining whether it's reasonably certain that the lessee will not exercise the option to terminate the lease. You have to factor in all those factors relevant to the likelihood. Again, those economic disincentives here, cancellation penalties, there's additional guidance on this as well. But when, the key difference here, both have an option to terminate the lease without permission versus only one party doing that. So factoring in, again, it's a nuanced discussion, it's a nuanced analysis that you have to look at and go through as part of that. Government enters into a 12-month non-cancelable lease in which the lessee has options to renew for 12 months at a time, up to 49 times. Is this agreement a short-term lease under Statement 87? No, it's not. According to paragraph 16, The maximum possible term of this lease has to be 12 months or less, including any options to extend. Those lessee renewal options, regardless of their probability of being exercised, means that this lease does not meet the definition of a short-term lease. So again, looking at how those leases are structured, how those leases are factored into it there. Question that may be there is, well, what do I look at as the lease term here in this case? If it's not a short-term lease and it meets the lease criteria here, you have to look at, okay, well, do you expect that the lease is going to be, held in place for the full 50 years, and then you base your calculations based off of that. So I mean, that's what drives the recognition and calculation part of that process. 12.17.6, Housing Authority enters into a 12-month residential lease contract, states the lessee may renew. If the lessee decides to renew, Housing Authority and lessee will enter into a separate lease contract at a later date for the subsequent 12-month period. Is this a short-term lease? The answer is yes. The maximum possible term as part of this is 12 months. They're entering into a new lease on an annual basis for 12 months or 12 months or less. So it does meet the short-term criteria. City leases boat slips and its marina to boat owners 12 months and does not contain an option to extend. Certain boat owner has signed a new lease every year for the past 20 years. City expects her to continue to do so. Is this a short-term lease? It is. Again, terms of the contract are what drive the short-term lease determination there. The fact that there has been a history of new leases being signed every year and it's a high likelihood that it will be signed next year is not relevant in the short-term lease determination for the city in this case. School district leases computers. At the end of the lease term, students are given the option to purchase their computers from the school district. Regardless of whether the students purchase those computers, the school district is required to purchase all computers from the lessor. School district does not have a termination option. Should this be reported as a lease or a finance purchase of the computers by the school district? In this case, we have a finance purchase here. Again, one criterion of a finance purchase, as provided by paragraph 19, is that the contract transfers ownership of the underlying asset to the lessee by the end of the contract. In this example, the lessee is the school district, not the students themselves. Purchase as required by the school district there. The sale of the computers directly to the students is treated as a completely separate transaction. The key code here, 690 as our next key code. Here, I'll give you a second to enter that. Question came in related to software for plant monitoring and email, Office 365. Those are generally not going to be covered under Statement 87. Those are going to fall, if applicable, under Statement 96 as part of that. So a little bit more time to kind of look into those, and we have additional training that'll be forthcoming on 96 and how that's structured there as well, but generally will not be covered by the lease guidance that's out there. 12.20.3, city leases a fleet of golf carts for its municipal golf course. The city will own the carts at the end of the agreement unless it exercises an option to terminate the lease, which it may do at any time without making further payments. For financial reporting purposes, is this transaction a lease or finance purchase? In this example, GASB tells us this is a lease. Paragraph 19 tells us that we can only have a finance purchase if the contract does not contain termination options. It can include a fiscal funding or cancellation clause that is not reasonably certain of being exercised, but if it does include those, a pure termination option, then this would be a lease transaction. 1222.1, the government adopts a capitalization threshold and expenses acquisitions, including lease assets, that fall below that threshold. Can the government apply a similar threshold to lease liabilities? GASB tells us that lease liabilities that are significant either individually or in the aggregate should be recognized. Authoritative pronouncements, GASB notes, do not provide specific guidance related to capitalization threshold amounts as part of that or determination of those amounts. even though they are often established. If you are going to apply a capitalization threshold to your leases, consider the quantitative and qualitative significance of that lease liability and the lease asset there as part of that process. So ultimately, GASB's guidance on leases is that if you're looking at the leases and these total amounts in the aggregate, as opposed to on an individual lease basis for that. So that's what drives the guidance here. So if it is something that is a lease, generally it's going to be included as part of that. Whether or not you do set and establish that threshold is something that can be discussed on an individual basis with your organization for that. But GASB, with much of their guidance on this standard, has said, if it's a lease and it meets the definition, you have to otherwise make the case for why it shouldn't be included. 1271.1, paragraph 47 requires a lessor to discount the future lease payments to be received during using the interest rate that the lessor charges the lessee. How should the lessor determine that rate? In many of these cases, there's not a stated interest rate. If you have a contract that has one, then your life is a little bit easier as part of this process. If there isn't a stated rate, then making a determination of whether the rate implicit in the lease can be estimated. Some additional guidance here that GASB provided. You can go through the process to calculate or impute interest as part of this, or determine what that incremental borrowing rate is as part of that, determining what that looks like. There are tools out on the market that you can look at there by way of example for tracking down those. Talking to your financial advisor is a way to do this. Couple thoughts on the rate calculations here. Initially, some of the discussion by auditors on this was that this was a particular higher risk area there. We've had some conversations internally on this. Part of it becomes a matter of the end result ends up the same. It's just which bucket it's reported in, as opposed from an interest expense standpoint versus recognition through another mechanism is in place there. The total amounts shouldn't be changing all that drastically as part of this kind of a geography, more of a geography where it presents on the financial statements more than anything else on that. Important to use a reasonable rate for that. It's important to have a consistent process in place for determining how you are going to determine that incremental borrowing rate. And also it's important to look at the term of the lease and factoring that in as well. Even if you just recently went to the debt market and have a recent term, doesn't mean that you should just blanket use that term or use that rate for the life of a contract. If you have a year-to-year debt issue that you were able to secure a favorable rate on, but we're talking about a 20-year lease, not likely to be an appropriate implicit rate for that calculation because it's a longer period of time. So factoring in the term as well as part of that. GASB does have some recent implementation guidance out for public comment right now. I am going to take a screen share real quick, just a different window for everyone here, just to kind of show you where to get some of this additional information. So bear with me while I switch gears and come to. So hopefully on the screen here, you can see the GASB.org homepage here, various different ways within the GASB website to be able to look at this information. My preferred way is to go under the standard and guidance section. You can see the pronouncement implementation guides here. Then GASB has a great tool referred to as GARS Online. GARS Online is GASB's research system tool here. You do not need a professional view. Everything is available under the basic view. You do have to go through and do the reCAPTCHA. Make sure you're not a robot there as part of that. So we'll do this real quick and see if it lets us in here. Can't quite see the images there. So we'll go to our basic view. accept the terms. And then when you come into the site here, I'm going to pull up a wealth of information for you here. If you click on the GARS tab here, it'll bring up all of the various components you can look at. So original pronouncements, you can come down to the statements, you can look at the implementation guides, things of that nature that you're able to look at as part of this as well. So if you wanted to come look at 87 itself, you could go through and do that. You could also go through looking at other documents in here. Really, again, a wealth of knowledge available here. If we look at documents for public comment, you'll see the implementation guidance for 2023 presented here. Let this take a second to load. While this is doing that, if we come through and look at the, so this is the implementation guidance comments due back to GASB on January 20th for this, but they do have what I want just to show you here. Within this is new questions and answers as part of this. So if we scroll to the new Q&A page here, questions on short-term leases here. Not going to go through it for the sake of time today, some of these additional questions here. But again, GASB has a wealth of information, a lot of detail out here on this. If you have questions or issues accessing GARS, feel free to reach out to me. Happy to help navigate that. So with that, I am going to pass things over to Greg, and we're going to go through a demo of our Lessee Ledger tool. So make Greg our presenter here.
All right, thank you, Anthony. Those implementation guide questions and answers are really helpful to better understanding some of the gray area of the standard and the application of it. So those are good to go through. What we're going to do for the rest of the session today is demonstrate some real world examples that we've seen with our clients and implementation so far that will help illustrate some of those concepts. We'll add a little bit more technical content in as we go through. But we also are going to show how a lease accounting tool can be really useful in this implementation, this transition process, as well as ongoing accounting. We will be using the Lessee Ledger tool that Sikich created. It's a proprietary Excel-based tool. If you are interested, it's available for license for a one-time fee. We can talk more about that at the end or address any questions that individuals may have on that after the session today. But you'll be able to see how we can utilize an Excel file like this to make the lease accounting much easier. So we're going to start out with probably our easiest example because we don't really have to do anything on this one. We wanted to highlight what the language might look like where you have a non-cancelable period or you don't really have an enforceable lease term beyond a short-term period. And so there is no recognition and measurement of a liability. Going back to some of what Anthony talked about, the lease term, there's a lot of Q&A on the lease term, and that's the periods for which both the lessee and lessor have the option to terminate the lease without permission from the other party are cancelable periods and are excluded from that lease term. So if they both can choose to cancel at any time, then you don't have a lease term beyond that sort of notice period, which we see here in the example language, where the contract continues until terminated by either party upon not less than 30 days written notice or on a month-to-month basis. So that's explicitly saying we really only have a 30-day enforceable term. Beyond that, we have no non-cancelable lease period. So we would not have to do anything with this. That is the distinction between whether the contract is not enforceable. If either party can terminate at any time, it's not enforceable, versus one party having the right to terminate is cancelable. It is important also to realize that GASB-87 takes a different approach with related party leases so that you can't structure leases to get around the accounting treatment. Paragraph 90 states that when it's clear the terms of the transaction are significantly affected by the fact that the lessee and lessor are related, then the classification and accounting should be modified as necessary to recognize the substance of the transaction rather than merely its legal form. So if this were a related party agreement, it may not be that clear cut that there's no enforceable period, considering the possibility that it was structured that way to avoid a longer term lease. So for our first example, where we're going to get into the lessee ledger tool, we're going to look at a fairly simple real estate lease. We have a commencement date of August 1st, 2020. It had a 2-year term with a renewal option of 2 years that's reasonably certain to be exercised. We have a straight base rent throughout the entire lease term. The renewal period rent was to be determined in the contract. It wasn't set, but it did say that the base rent would continue to apply for the renewal period. And prior to application, this contract was renewed and confirmed that it was the same rent amount for the future period. So we're going to use that base rent for the entire 4-year term. And it also included provision for utility payments. However, it's a non-lease component, and so it's accounted for as a separate contract in accordance with paragraph 64. So we don't need to do anything with the utility payments as far as our measurement and recognition of the lease liability and asset. Our discount rate assumption for all of these examples is going to kind of follow the same model where the implicit rate is not readily determinable. That's going to be very common for most leases. If it's not stated, the lessee is not going to be able to readily determine it. And so we'll need to rely on a incremental borrowing rate based on the specific characteristics of the lease. These will all be determined as of our application date. We are using an application date of 1/1/21 for a prior retrospective period where we will be applying it back 1 year, and then looking at remaining lease terms for the determination of those incremental borrowing rates. So I am going to jump into our lessee ledger here and show you how the input process and how the information can be generated for you much more quickly than trying to calculate these individually, as well as then we'll get to some aggregation of the data towards the end of the demonstration. So we have this set up where our calculation worksheet is a hidden template in the file so that you always start with a clean starting worksheet. By simply clicking the button, it will ask us to provide a name for it, copy it, and then enter that name. As I go through, the lighter shaded cells are not required. A calculation can still be completed without those. They may apply and they may need to be entered, but they're not required. The darker shaded cells really are necessary for an accurate completion of a calculation, as well as the roll-up of information for journal entries, disclosures, etc. So some of these will be just free-form entry. Others will have drop-down selections available based on information in the file. So Lessee Ledger does let you define your fund structure, as well as your functions and programs and asset classes. So it's customizable. You can select them for each individual lease so that we get our accounting treatment correct based on the basis of accounting, and then the roll up for our disclosures in the appropriate classifications. So also select our function, and our asset class for this we said was real estate. We commenced this lease on August 1st, 2020, and we said it was a 4-year lease, so we'll enter 48 months. The tool is going to automatically start the calculation at our application date. You'll see down towards the bottom, our first period there is January 21, even though we are entering information for the entire lease term, it will pick that up correctly. We're just going to indicate that our payments are due at the beginning. You can choose the end if that applies, although I think that's pretty rare. And then our discount rate for the lease that we set our incremental borrowing rate in this example was 1.75%. For entering our payment structure, there are a few options pre-built into the tool where if you have fixed annual increases based on $1 or percent, you can utilize this to populate the entire schedule. Or if you have a more irregular pattern, you need to manually enter, you can also choose that. But for this example, our payments were $734 a month for the entire lease term. And having entered that, we can check quickly that everything appears calculated accurately, that we don't have any unresolved issues and no open cautions or diagnostics that we need to deal with. And we will then see that we have our beginning lease liability calculated for us at the $30,615 with the same starting point for our right of use asset. And then concepts that you're familiar with, we have essentially a debt amortization table here where we have our accretion of interest offset by our recurring payments to resolve down to a zero balance at the end of the lease term. And similarly, on our right of use asset table, we have our amortization over the lease term to have a fully amortized asset at the end. Our periodic expense is going to be presented for us. You'll notice because amortization expense is straight lined, our total lease expense is going to decrease over the lease term relative to the interest. And then we also have journal entries for each accounting period. We don't expect that users would use the journal entries here to post to their accounting systems because we are going to summarize those by fund on our journal entries tab to make that a little bit easier, but that's there to have that level of detail to look at. So that is probably, as straightforward as a lease might be in entering the terms for the calculation. Here we're going to look at a scenario where we had non-consecutive payments. This was a lease of a seasonal lease of golf course equipment. So they were really only utilizing it from May through September. That's when their payments were due to correspond with when they were generating revenue and utilizing it. There could potentially be a question here of whether they had control during the other 7 months of the year, or did they just have control for those 5 months of the year? In this case, they did have control throughout the entire 5-year term, but it really wouldn't matter anyway, because going back to one of the implementation guide questions that Anthony covered, you can have interrupted periods of control or non-consecutive periods of control that together add up to the lease term. So even if they didn't have control those other 7 months, we would still have a 25-month lease period in total for the 5 months during each of those 5 years. And we would still have a lease that would require us to measure and recognize. For this example, we're going to use an incremental borrowing rate of 2.15%. A lot of these incremental borrowing rates are sort of hypothetical based on the scenarios, and they are really going to depend on entity-specific characteristics and credit risks, as well as the underlying assets and the periods of time. So to jump back into our accounting tool, we're going to add another lease calculation worksheet and follow a very similar process of entering our lease terms. This one is going to be different in the fact that because our payments are due each those 5 months of the year, not every month of the year, we're going to use that manually enter schedule. So our commencement date was December 8th. It was a 5-year lease. Payments are due at the beginning. We'll enter our incremental borrowing rate. And then I mentioned we'll come over here and select the manually enter payment schedule. When we do that, you get an input column down here in our lease liability table, which will allow us to enter whatever the payment stream happens to be, and it will update for us as we go. So starting in May, we were making monthly payments of $1,085 through September. And we are doing that for the remainder of our lease term. So you can see we have non-consecutive periods here, non-consecutive payments. We do have a small difference remaining at the end of this. That 17 cents is going to be plugged as part of our final journal entry. That's tied to lease commencement dates that aren't at the beginning or end of the month. So mid-month leases may have small rounding adjustments to be corrected. But again, we can double check our entry. It is going to let us know that we have a small difference here, but our only remaining caution or diagnostic is the same, just letting us know that we've not entered an economic life, so it's going to assume the lease term is the appropriate amortization period for this lease. Our final code word for today, we've got a bit of content left yet, but our final code word or code number is 954. Again, that is 954. Our next example that we're going to look at is one that involved multiple components or multiple underlying assets, and what's the appropriate accounting for that. So just to revisit some of the guidance in the standard, paragraph 64 does say that government should account for lease and non-lease components as separate contracts unless they meet the exception of paragraph 67. We looked at that a moment ago when we had the utilities. But paragraph 65 also says that if there are multiple underlying assets and they have different lease terms, those should be accounted for as separate lease components. Or if the underlying assets are in different major classes of assets for disclosure purposes under paragraph 37C, then those also need to be accounted for as separate lease components, so that, again, if your terms are different, your calculation for each underlying asset is going to be different. And if they are different classes of underlying assets, they need to roll up into the disclosure information separately. So if you meet either of those conditions, then it is necessary to account for them separately. But if your underlying assets have the same lease terms and they're essentially the same type of asset, you can account for them as a single calculation. The math will work out the same. It will get you to the same end result, whether you do them all together or separately and add them up. So we're going to do an example where we had multiple ground maintenance equipment items included in a lease, but they all had the same start and end dates, and there was no reason to perform a separate calculation for each of them. You may want to be careful when you do that in situations where you have renewal options or purchase options that are available for each individual unit and may be exercised differently. Because if you were to purchase one and not another, or renew one and not another, then you're going to have to break that calculation apart at that time to allow one to terminate and then continue on the other. So that's something to keep in mind when you're looking at that potential shortcut for performing the calculations. So as I mentioned, this is going to be an example of a lease for grounds maintenance equipment. I think this was tractors for mowing and other maintenance activity. Again, we have a commencement date prior to our application date, 5 years in total. And in this lease, the payments were due annually on the anniversary date of the lease. There were variable payments that will be based on excess hours that will be determined at the termination of the lease. Often we see these corresponding with the timing of payment. So they may bill for excess hours or excess mileage or whatever the measure happens to be on a monthly or annual basis. And we would need to account for those on a monthly or annual basis. In this example, it happens to just be a catch up at the termination of the lease. They'll look at the total usage for the lease term and bill for any excess at that time. So we don't have anything to include for those variable payments. And there was a purchase option, but it is not reasonably certain to be exercised, so that will not factor into our accounting at the implementation. For this one, we're going to use a discount rate of 2.25%. And I will again jump back into our lessee ledger tool to demonstrate some data entry for this lease. We start off with our clean calculation worksheet. We can select our fund, function, and asset class again. You'll notice that I'm selecting a different fund for each of these. You don't have to do that. Obviously, you wouldn't do that if they're all in the same fund, but that's going to allow us to illustrate the journal entry functionality in just a moment when we get all of our leases entered. So September 8th, 2020 was our commencement. It was a 5-year lease. Payments due at the beginning of each year. 2.25% incremental borrowing rate. And we will again manually enter our payment schedule because we just need to be able to enter our annual payments in each September. So as I enter these, the calculations will continue to update for you throughout the end of our lease term here. If you do have lease incentives, other items, incentives that are receivable at commencement or later become received, you can include negative amounts in your payment schedule to recognize the timing of an incentive that you may receive. And again, that will properly flow through the calculation here for you. So you can see we start out at the same lease liability and right of use asset at our initial implementation, and amortizing down over the remainder of that period. We do have the lease liability and accrued interest separate. So this is a good example to be able to view that our lease liability does not change during the periods in which there is no payment. We just continue to increase our accrued interest balance until we get to the next payment. Service contracts. The standards are putting more emphasis on contracts that contain leases and maybe weren't previously identified as a lease or were treated as a service or supply arrangement, because there is significantly different accounting treatment for leases now that they're on the balance sheet. So we need to make sure that we identify those leases that are embedded within other contracts. This one was pretty clear. However, it was labeled as a professional services contract. It was in the contract discussed as a provision of professional services. But really what they were doing was providing radio communications equipment and then maintaining that network on behalf of the entity. They were making sure it stayed up. They were doing any repair and maintenance that was needed, any troubleshooting, and just general support of that radio communications network over the time. So there are identified assets included within that contract, which the government had control over for the contract period. The contract commenced in February of 2019, happened to again be a 5-year contract. We have monthly payments as well as a renewal option, but in this case, that renewal option was not reasonably certain to be exercised. Our incremental borrowing rate for this example is determined to be 2%. So we'll go back in, quickly enter this example. Following, again, the same process. This becomes a little bit of a redundant process as you go. It does get easier each lease you enter. We do have the option to import lease terms automatically. So if they are laid out in Excel template format that's needed, you can skip all of the clicking steps here that you're seeing to speed up this process if you have a larger lease portfolio. But we'll enter our commencement date, our term of 5 years, payments due at the beginning, 2%. This one's going to be a little bit easier for us because it was the same payment amount throughout the entire lease term, like our second example. So we can enter that monthly payment amount and have everything completed for us that quickly. Liability, right of use asset, our periodic expense, and journal entries with just a few inputs. Our last example is going to get a little bit more interesting. There's a few extra things to consider with this example, and so we are looking at one that has variable payments. Paragraph 21 talks about variable payments, and that a lessee initially should measure the liability at the present value of payments expected to be made during the lease term, including, if required, variable payments that depend on an index or rate, such as a consumer price index measured at that initial rate, or any variable payments that are in substance fixed. So if you have a choice of payments, but essentially, there is a fixed amount, or if there is a minimum increase, even though it's based on consumer price index, if there's a minimum increase, that increase is in substance fixed and would need to be included. Paragraph 94 also provides some additional transition guidance on this, saying that if applied to earlier periods, leases should be recognized and measured using facts and circumstances that existed at the beginning of the earliest period restated. So for some of these arrangements, you're going to have to get back in a time machine a little bit and go back and look at what the terms were, what were the facts and circumstances, what were the payments that were required at the beginning of the earliest period restated. So we're going to use the information we knew at that time for our initial calculation for the lease. This example is again a real estate lease. It did have multiple components, however, they all have the same lease terms. You may need to be careful in some of these examples, as we talked about, in determining that they're all reported in the same asset class. So if you have underlying assets that are land and buildings, potentially need to be separated out and calculated as separate lease components because of the fact that they will have separate disclosures included in the different asset classes in the disclosures. This lease was a bit longer. It commenced in 2014 and had a 22-year lease period. There were 5-year renewal options, 3 of those for a total additional 15 years. However, that far into the future, they were not reasonably certain to be exercised, so we're not including any of those renewal options in our calculated lease liability. The base rent initially in 2014 started out at $7,651 per month. But as I mentioned, there was a rate increase in there that was the greater of the change in CPI or 2.5%, but couldn't exceed 4%. So in any given year, we know we're going to have an increase of 2.5% at least. If the change in CPI is greater than 2.5%, then it'll be some other number, some other percent increase up to 4%. So it's that amount between 2.5 and 4 that's truly variable, that we don't know what the payment will be, but we know it's going to be somewhere in between there, at least 2.5, no more than 4. And then for this example, the incremental borrowing rate is determined to be 2.75%. Our incremental borrowing rates for all of these have been different, and I think that generally is what can be expected, that your incremental borrowing rate should be specific to the terms of the lease itself, not necessarily a single incremental borrowing rate for the entity. So you should expect to see some variability in the incremental borrowing rates that are determined for each of the leases. I think Anthony mentioned that there's been some internal conversation on what's the significance, how impactful is that, and so slight variations in that estimate likely are not going to cause significant differences in the financial statements, because it becomes more of a income statement type classification issue. So before we jump in, go ahead.
Just to add, I think just the biggest thing with that is being consistent in your approach and using a similar methodology for those is going to be one of the biggest of that, that incremental borrowing rate calculation, just to add some additional.
Yeah, that's a great point. So before we jump into this example, one more thing to consider is, getting in our, looking backwards to our earliest period presented. So going back to 1/1/21, what did we know at that time? This lease commenced in 2014. We started out at $7,600, but we know we had annual increases from that point up through 2021, at which point our actual payments that we were making based on past experience were $8,894.77. So this is going to be our starting point. This is our payment based on what is required at 1/1/21 that we will begin our liability calculation off of. We are going to add in that 2.5% increase though for future periods, because we know that 2.5% increase will be there. That is in substance a fixed increase. It could be more, but it certainly won't be less based on the terms of the contract. So we're going to set this one up slightly differently so that we can utilize some of the functionality of Lessee Ledger to shortcut for us. Same process of providing classifications or groupings for the lease. But this time, we're not going to go all the way back to our 2014 commencement date of the lease, because we want to use the payment that we knew we had at 1/1/21 and use that to carry forward our 2.5% increase. So I'm actually going to commence this as of 7/1/2020. So that is the first lease year prior to our application date. The lease term then is 16 years remaining from that point. So again, we had 22 years total, but if we're using 7/1/2020, we'll use our 16 years to get us all the way through June of 2036. Payments are due at the beginning. Our discount rate was 2.75%. And here is where we will be able to use this percent increase functionality. And I will zoom in just in case it's a little bit hard to see. We're going to enter that payment amount that we know that we were making at 1/1/21, but then we will indicate that we have a 2.5% increase that will occur on the anniversary date of the lease, so every July 1. And by doing that, the lessee ledger tool, and some of these columns, and you zoom in, need to be a little bit bigger with the big numbers, will automatically add in that 2.5% increase for us every July 1st, so that we don't have to calculate that out, make another schedule, and put that in here as a manual input. That will automatically apply those 2.5% increases for us throughout the lease term. So with this, we have a starting point of $1.6 million for both the liability and right of use asset, and we have the same information throughout the end of the lease term as we had for all of our other examples. I do want to take this one step further to talk about some of the subsequent accounting then with the variable payments. How are those changes in the future lease payments then handled? And so if the lease liability is not required to be remeasured solely for a change in the index or rate used to determine the variable payments. So we don't have to remeasure this every year that CPI adjustment is determined. We've already included the 2.5%, but we don't have to remeasure when we know it's 3 or 4%. That additional payment is going to be recognized as an outflow of resources in the period in which the payments are made. And then the notes to the financial statements are going to disclose that amount as additional variable payments. Our lessee ledger tool will allow you to do that by entering actual payments made in this column here. So if no payments entered, it recognizes there is no variable expense. However, if we go back to our payment table here, 21-22, we were still at 2.5% because our CPI didn't increase. But once we get to 22-23, we are actually having a larger increase. We're going all the way up to 4%. So this $9,481.83 is not consistent with the scheduled payment based on the 2.5% increase. If I remembered that number correct, the $9,481.83, we could copy that in and paste for the entire year so that we get all of our variable portions. That becomes part of our journal entry then for those periods to allow us that ongoing functionality. To kind of wrap up on lessee ledger, I think that demonstrates some of the utility for initial implementation and the initial calculations. But there is a lot more built into the tool. The default limit is 100 leases. We've done projects larger than that with this tool, so that is possible. But you also have the advantage of having your journal entries summarized for you. So when we come back to our index tab, it's automatically updated. It's hyperlinked. So if you have a large portfolio, it's easier to navigate. You can jump around with that rather than finding your tab down here. But then our journal entries are automatically going to be populated for the accounting period that we specify. Right now, we're still on that first year of implementation, so we're looking at information as of 12/31/21. The journal entries are presented by each of the funds that we assigned leases to, as well as our government-wide combining accounts, and they are separated by fund type, governmental funds, proprietary, discretely presented component units. And so you'll have that information to post summarized journal entries for all leases that you assign to them. You also have your disclosure information summarized for quick reporting, summary of lease-related assets and liabilities, your lease asset roll forward by class of asset, your lease liability roll forward by fund type. Other information may need to be manually collected from your general ledger. It's not captured within the tool. And then your maturity of lease liabilities for each of the next 5 years, and then in 5-year increments thereafter. You will continue to use this on an ongoing basis. So if we change our reporting date to the next calendar year, you'll see our journal entries are less substantial because now we're not recognizing the initial capitalization of those assets and liabilities. In many cases, we're just recording the activity, as well as our disclosure information then being automatically updated for that next year. There's also a roll forward schedule. This is helpful just for a quick check of the activity during the period for the liabilities and assets. This is something that as auditors we'll be interested in seeing in future periods so that we can quickly get an understanding of the activity in the lease portfolio during the year. But again, it's a good quick check for reasonableness and accuracy. Also looking forward, there is the ability to record asset impairments if they were to happen, to remeasure lease liabilities and right of use assets when required, if there are changes in assumptions about whether it's reasonably certain to renew or terminate or purchase. That functionality is built in and there to make that subsequent accounting easier, as well as a number of other input cells. We do have noted here that the maximum lease term by default is 40 years. I think occasionally we see some land leases and other things for longer periods of time. If those are not for nominal amounts and below recognition thresholds, that's something that can be accommodated. And I also mentioned that we do have some data transfer tools that will help you import or export data from the tool. So if you want to bypass all those steps of clicking, as long as the data is laid out in a format that's needed for import, it's a click of a button and it will create each of them for you in just a few seconds per tab. So with that, I know that we are up here at the end of time. Anthony and I have provided our contact information here. We're happy to answer any questions that you have following the presentation. I see we have a few in queue that we probably won't get to them or get to them all, but we can send out some responses after the session.
We can probably pop through a couple of these pretty quickly. So I want to go back to the question asked earlier in terms of the, the question on the, lease to own, contracts as certificates of participation. So GASB on the lease to own standpoint there, paragraph B8 of the standard and the basis for conclusions really addressed that, the need to look at the substance of the arrangement rather than the label on the contract. So if it truly is a contract that transfers ownership of that underlying asset, then that's going to be treated as a finance purchase. The fact that it's called a lease in the arrangement document does not necessarily mandate that it's going to be reported as a lease under Statement 87. Certificates of Go ahead.
I would say one of those implementation questions you touched on it too, talking about that there needs to be no termination options included as well for it to be finance purchase. So
correct. Yeah. And then certificates of participation, a little bit different. Those need to be looked at on a case-by-case basis. Reason being, basis for conclusion, paragraph B15, GASB actually did consider whether to exclude certificates of participation directly. However, because some leases form the revenue stream that support repayment on those certificates, the board believes that the association of those lease payments with certificates of participation, doesn't affect the lease transaction. So there's not a blanket exclusion for such leases in that regard. The other question specific to lessee ledger, real quick on these. Does the software tool also work when the city is the lessor? Can it calculate the entries in reverse? Short answer is no. It's built on specifically to the lessee standpoint, kind of based on our, what we found is the need for the majority of our potential users on that. Could you back into some of those calculations and the associated entries with the tool? Certainly, but it is geared more towards the, it is geared specifically to the lessee side of things. Cost for the program, if you're interested in more detail on the tool or utilizing the tool, feel free to reach out to Greg or myself on that. It is generally, few of the benefits that we have with the tool versus some of the other products on the market. One, we're, there's maybe only one other tool on the market that I'm aware of that actually has the capability to calculate these amounts based on the different funds and opinion units and the entries and everything associated with those. And then there's not an annual cost for this tool. It's a one-time licensing fee for the tool, and then you own that tool and have the ability to utilize that tool. Last question I'll cover here, for example, and then we'll circle back on any additional questions that may have come in here. But the last question, just to highlight, do you need to record the amortization of the lease monthly, even if the payment is received once a year? Short answer is no. The tool is designed for monthly information there, but you can tailor those calculations and entries that you need to your specific to your specific organization on that. You do not need to do a monthly transaction or monthly recording on that. You can aggregate those using the the information Greg's got up on the screen here shows the annual amounts as part of that, so you'd be able to utilize that. You just have
the journal entries are annual. The ones that are presented for posting in the journal entries tab are on an annual basis.
Cell tower, there's one cell tower question. We'll go ahead. I'm not going to be able to cover that, but there was an example on that there. I would encourage you to look at the guidance and the Q&A specific to that there. But if you have questions, further questions, feel free to reach out. With that, we're going to go ahead and end today's session. I'm running a few minutes over, but hopefully a lot of useful information for you. Again, if you're interested in any additional information on the Lessee Ledger tool or have any additional questions as you go through the material, happy to address those. And with that, thank you for your time and hope everyone has a good rest of your week. Take care.
Thanks, everyone.
A brief reminder, if you haven't checked out of Conferences.io, please be sure to do so for CPE. Thank you.
Thanks, everyone.